Hi, I'm Linda Eedes. This is an update on the RECM Equity Fund, looking specifically at the third quarter of 2019. Looking at the fund's returns during that time frame, comparing that to the local equity market, identifying some of the contributors and detractors to those returns, some of the changes to the fund during the quarter, and of course summarizing with how the fund is currently positioned. So for the third quarter of the year, the fund was down slightly, negative 0.9% after fees. But that is compared to a pretty negative backdrop. The JSE All Share Index was down 4.6% during the third quarter. So the fund actually held its ground very well during that time frame. And I think this speaks to one of the advantages of the way that we invest. You will know that we're value oriented, so we want to buy investments which are already trading at very low prices. The advantage of this is that you're not investing in parts of the market which are often crowded, hyped up, overvalued, where there are high expectations, and when there's significant market downward action, you participate in that. Often we are investing in such different stocks that when the market comes under pressure, we actually tend to hold our ground pretty well because we invested so differently to the market index. That certainly was the case over the quarter, and it's part of the reason, a big part of the reason, why the fund has done so incredibly well since the beginning of 2016, when markets have been a little bit more tumultuous and obviously from quite high equity levels have come under quite significant pressure, particularly if you look at the large caps within the South African equity market. So since the beginning of 2016, the local equity fund, the RECM Equity Fund, is up 47% after fees. And that's compared to the All Share Index, which is up 20% over that same time frame. So you can only outperform to that extent if you are positioned very, very differently to the market. We are positioned differently for two reasons. Firstly, because of our style as value managers, we don't start with the index and take under and overweight positions. We only invest in those businesses which we believe to be trading at a significant discount to their fair value. So we tend to hold quite different exposure to what the All Share Index would start with. And then secondly, our size. So our sort of willingness to hold different stocks and our ability to hold different stocks. So within this fund, about half of our equities are within the small to mid cap space. So we have the full opportunity set within the local equity market to actually deviate quite substantially, to actually position our portfolios quite differently to the overall market. And that's obviously a huge advantage when there are some risks inherent in market prices at the overall level. The fact that we can move quite significantly away from that can be a huge part of how we generate good long-term returns. And that certainly has been the case where we've seen markets come under pressure. That was the case in 2018, and then we had quite a rebound in local equity markets. But certainly as part of a diversified portfolio of funds, the RECM Equity Fund can provide something very, very different to perhaps exposure that investors might be getting from other asset managers, particularly larger asset managers, because as I say, even if they're value oriented, they may not be able to access parts of the market that we can access. In terms of what generated those returns during the quarter, that negative 0.9%, some contributors, some of the things that actually held up returns relative to the overall market were, for instance, the gold producers in the fund. We have a basket of gold stocks, a 5% allocation to gold producers. That's really to get exposure to gold in terms of the commodity at a discount, because the gold prices are trading at a substantial discount on top of that. That provides some insurance to the portfolio. And of course, with gold prices actually benefiting from sort of very low interest rates over the last quarter, that actually was a boost to those share prices. Implats has continued to generate very good returns for this fund. It was up another 27% in the third quarter. Obviously, it's been quite a bumpy ride for investors who have been with Implats for a number of years, but that investment thesis has eventually played out somewhat differently to expected, in that palladium and rhodium have been the metals which have actually generated the upside, not platinum, but certainly the PGM basket as a whole is up more than 50% over the last 2 years. So that has certainly benefited platinum producers such as Implats, which was very highly leveraged to those prices. Another interesting one, which speaks specifically to that advantage which I was speaking about within the small to mid-cap space, is our position in Metrofile. Now, you'll probably recognize that name. It's the record and data storage company. And this is a company that, like many other small and medium-sized companies, has been under immense pressure given sort of the local economic backdrop, and was trading at extraordinarily low prices, having come off quite significantly, and is now, it seems, an acquisition target. So there's been news in the market that they are about to be acquired, or certainly someone is going to make a bid for them, and that saw the share price going up by more than 75% from its lows in August. So I think this speaks to another advantage, which is that we can include a lot of very, very attractively priced opportunities which can behave completely differently to what the rest of the market can do because of the specifics of their fundamentals being attractive with the backdrop and becoming, in many cases, acquisition targets. Now, that's a 1 billion rand market cap company that is just not available to larger or even medium-sized asset managers in any meaningful size within the portfolio. And the interesting thing about this is that if you include as many of these as possible where, you know, downside is limited, but there's substantial upside, you really are accessing a very, very attractive opportunity set for value investors currently today within that space. Some of the other areas of the market that came under pressure, which impacted the fund, were, for instance, through our investment in HCI. This is Hoskin Consolidated Investments. They are probably most noteworthy in terms of their stake in Tsogo Sun. Now, this is an investment holding company which has got an excellent track record of capital allocation over time. It's sort of headed by one of the best capital allocators in South Africa. And if you actually look at HCI's share price and you don't even take into consideration its mining interests, its media interests, its transport interests, its share price actually trading below its stake in Tsogo alone. So even at its listed share price, Tsogo, which is arguably very undervalued itself because of the tough domestic economic conditions, which has impacted gaming and leisure, the share price for HCI is trading at a discount to that. So you're getting everything else for free and then some. So we believe that's an extraordinary value opportunity, and that is why that is one of the top holdings in our fund currently. Some of the parts of the market which came under pressure, which we do think still offers substantial value, are, for instance, domestic bank First Rand. So if you look at the changes during the quarter, we actually were able to allocate to more equities. We actually took the equity allocation from 76% to 80% during the quarter. Some of the new exposures included, for instance, ShopRite. Now, we included a 3% allocation to this business, a high-quality retailer. Of course, it's down 60% from its highs in early 2018. Now, in early 2018, probably investors were very comfortable holding it at that share price, not so much today, which we believe is kind of counterintuitive. You should want to be buying retailers when they are under pressure, when the share price is 60% from its highs, when the price makes a lot more sense in terms of potential upside from this point going forwards. So we did include an allocation to that towards the end of the quarter, and in actual fact the share price is actually up from what we paid for it. We also increased our net basket, which is basically a basket of stocks which are trading below liquidation value. That is about 5% of the portfolio, and we increased our allocation to our spin-off basket. So there, basically, we include a tiny allocation to each company that is spun off, with the premise that when it's spun off, there are a whole lot of investors who get that business, who sell it because they don't want it anyway, and there's downward share price movement which has got nothing to do with the underlying fundamentals of the business. If you take advantage of that, there is often collectively quite nice uptick in terms of value creation from that point onwards if you hold that basket of spin-offs for a period of time. So overall, cash is slightly down, but is still a meaningful allocation in the fund. It's about 20% of the overall fund. And we have a really nice diversified set of different companies in different sectors, actually all with one thing in common, which is that they're trading at a substantial discount to what we believe to be their fair value. And what that does is hopefully protect in terms of further downside and create the opportunity for substantial upside. And one of the analogies I recently heard, which I thought really explains this very well, is that you don't have too far to fall if you're falling out of the window of the ground floor, in comparison to falling out of the floor at the 30-story level, where high expectations have caused significant downside from that point, should you turn out to be incorrect.